Today, we are going to tackle the language of the stock market. You know, it's one of those things that can sound super complicated, but trust me, it really doesn't have to be. So, have you ever been watching the news or talking about investing and just felt like you got hit with a wall of jargon? You hear words like dividends or volatility, maybe bull and bear markets, and it feels like this exclusive club you're not a part of. Well, I'm here to tell you it's not. In the next few minutes, we're just going to cut right through all that noise. I'm going to give you some really simple, clear definitions for the most essential terms. The goal? To help you feel way more confident and in control. All right, let's start at square one. Before we can even get into markets and profits and all that stuff, we've got to know, what are we actually buying and selling here? So what even is a stock? It's actually way simpler than it sounds. A stock just means ownership. When you buy a stock, you're not buying some abstract concept. You are literally buying a tiny piece of a real business. You get to be a part owner. How cool is that? And a share? Well, that's just the unit we use to measure that ownership. Think of the company as a giant pizza. One share is one slice. So if you buy 10 shares, you own 10 slices of that company's pizza. Simple, right? Okay, so where do you go to buy and sell these slices of company pizza? You guessed it, the stock market. It's really just a massive marketplace. But instead of buying apples and oranges, people are trading ownership in companies. Alright, so now we know what's being traded. Let's talk about let's call it the mood of the market. You hear it all the time, right? The market's up, the market's down. There's some specific and kind of funny terms for that. I'm almost certain you've heard these two. We've got the bull market and the bear market. A bull market, that's when everyone's feeling optimistic and prices are generally on the rise. A bear market is the total opposite. Everyone's pessimistic and prices are heading down. Here's a super easy way to remember it. A bull thrusts its horns up, while a bear swipes its claws down. But let's back up. Why is anyone even buying stocks in the first place? Well, duh. The goal is to make money. And it turns out there are two main ways that can happen. Those two paths to profit are earning dividends and getting what are called capital gains. So let's break down what each of those actually means. First up, dividends. Just think of this as a thank you gift from the company for being an owner. Some companies, usually the big stable ones, will actually share a piece of their profits with you. They'll send you a cash payment just for holding their stock. Now, on the flip side, a lot of younger, fast-growing companies might not pay dividends. They'll take that money and plow it right back into the business to try and grow even faster. And the second way to make money is a capital gain. This is the one everybody knows. Buy low, sell high. It's exactly what it sounds like. You buy a share for, say, $10. The price goes up, and you sell it for $15. That $5 difference? That's your capital gain. That's it. Okay, so we've got the basics down. We know how you can make money. Now let's talk about building your investor toolkit. These are some of the key ideas and tools you'll need to actually manage your investments. First thing in the toolkit, your portfolio. Honestly, this is just a fancy word for your entire collection of investments. If you own stock in 3 different companies, well, those 3 stocks are your portfolio. But this leads to a really important question. One every investor has to ask. How do I protect my money? You know, if one of my investments tanks, how do I make sure I don't lose everything? The answer is a word you've probably heard before. Diversification. It all comes down to that classic advice. Don't put all your eggs in one basket. It's that simple. By spreading your money around different investments, you lower your risk. So if one goes down, hopefully the others can help pick up the slack. So how do you diversify? A really common way is to invest in companies of different sizes, or what we call market caps. Think about it like this. Large cap companies are the big established giants. They're usually more stable. Then you have small caps. These are the smaller, scrappier, up-and-coming companies. They have way more potential to grow, but yeah, they also come with more risk. A really solid portfolio usually has a healthy mix of different sizes. You might be thinking, okay, that sounds like a lot of work. So is there an easy button for beginners to diversify? Yes, absolutely. That's where something called an ETF, or exchange traded fund, is a game changer. When you buy just one share of an ETF, you're actually buying tiny little pieces of all the different companies inside that fund. It's like instant diversification in a single click. Okay, we're almost there, but let's get to what I think is the single most important principle you have to understand before you even think about investing a single dollar. In that principle is risk versus reward. Look, in the world of investing, these two are forever linked. You can't have one without the other. If an investment has the potential for massive profits, it's almost guaranteed to come with a higher risk of losing your money. And on the flip side, lower risk investments usually mean slower, more boring, but stable growth. And that idea leads us perfectly into our final term, volatility. All volatility means is how much a stock's price swings up and down. Is it a calm, gentle wave or a wild roller coaster? A highly volatile stock is that roller coaster. It makes big, fast moves. So here's the key takeaway. Higher volatility means higher risk, but it also means a higher potential for reward. See, it all connects. And that's really it. The stock market can seem so intimidating from the outside, but once you start to understand the language, everything just starts to click into place. All these terms we've talked about today, they're the building blocks you need to see that bigger picture. Learning this language really is the most important first step. So I'll leave you with this question to think about. Before watching this, which of these terms confused you the most? Just thinking about that for a second will help lock in everything you just learned. Thanks for joining me.